Preparing for Assurance Associate at EY interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to join EY Assurance as an associate? I want to start in EY Assurance because audit gives the strongest foundation in financial reporting, controls, and business processes. EY's client base would let me see different industries early, while the firm's methodology and coaching culture would help me develop discipline. I also like that EY is investing heavily in data analytics and audit technology. For me, assurance is a place to build technical depth, professional judgment, and client-facing confidence. While answering, focus on EY's audit reputation, exposure to diverse clients, learning through structured methodology, technology-enabled assurance, and your interest in building a strong accounting and controls foundation. Question 2. Walk me through the main stages of an external audit. An audit starts with planning, understanding the client, industry, materiality, and key risks. Then we assess internal controls and decide whether to rely on them. After that, we perform substantive procedures such as confirmations, recalculations, analytics, and vouching transactions. Near completion, we evaluate misstatements, review subsequent events, assess going concern, and obtain management representations. The final output is the audit report, supported by evidence that is sufficient and appropriate. Make sure to cover planning, risk assessment, internal controls understanding, substantive testing, completion procedures, audit opinion, and how each stage connects to gathering sufficient appropriate audit evidence. Question 3. What are audit assertions, and why do they matter? Audit assertions are the claims management implicitly makes in the financial statements. For example, recorded inventory exists, payables are complete, receivables are collectible, and disclosures are properly presented. They matter because audit procedures are built around risks to those assertions. If revenue has a cutoff risk, I test whether sales were recorded in the correct period. Assertions keep the audit focused and help link risks, procedures, evidence, and conclusions. In your answer, talk about management assertions such as existence, completeness, accuracy, valuation, rights and obligations, and presentation. Then explain how auditors design procedures around them. Question 4. How would you explain materiality in an audit? Materiality is the level at which an error or omission could influence the decisions of financial statement users. Auditors usually set it using benchmarks such as profit before tax, revenue, assets, or equity, depending on the client. Performance materiality is lower and helps reduce the risk that uncorrected errors aggregate above overall materiality. Materiality drives sample sizes, testing depth, and how we evaluate identified misstatements at the end of the audit. Be sure to mention materiality as a threshold for user decision-making, common benchmarks, performance materiality, trivial thresholds, and how materiality affects testing scope and evaluation of misstatements. Question 5. What is the difference between tests of controls and substantive testing? Tests of controls evaluate whether a client's control is designed and operating effectively. For example, checking whether purchase orders are properly approved before invoices are paid. Substantive testing directly tests account balances or transactions, such as confirming receivables or vouching revenue to contracts and invoices. If controls are strong and we can rely on them, substantive testing may be reduced. If controls are weak, we usually expand substantive procedures. While answering, distinguish whether the auditor is testing control effectiveness or account balances, include examples of each, and explain how strong controls may reduce substantive testing. Question 6. How would you test revenue in an audit? Revenue is usually high risk because it directly affects profit and may involve judgment. I would first understand the revenue process and recognition policy. Then I would test samples by agreeing sales to contracts, invoices, delivery evidence, and cash receipts. I would also test cutoff around year-end to ensure revenue belongs in the right period. Finally, I would perform analytics, such as comparing revenue trends by month, customer, or product to expectations. Make sure to cover revenue recognition risk, cutoff, occurrence, accuracy, contract terms, supporting documents, analytical procedures, and why revenue is often treated as a significant audit area. Question 7. What would you do during an inventory count observation? At an inventory count, my role is not to count everything. It is to observe whether management's count process is reliable. I would watch how teams count, tag, segregate damaged goods, and control count sheets. I would perform test counts from physical inventory to the client's records, and from records back to the floor. I would also note slow-moving or obsolete items because they may affect valuation. Any exceptions need clear documentation. In your answer, discuss observing client count procedures, performing test counts, tracing from floor to listing and listing to floor, identifying obsolete inventory, and documenting exceptions clearly. Question 8. How would you audit accounts receivable? For accounts receivable, the two big concerns are existence and recoverability. I would send confirmations to customers where appropriate, especially for large or risky balances. If confirmations are not returned, I would perform alternative procedures, such as checking subsequent cash receipts and supporting invoices. I would review the aging schedule to identify overdue balances and assess whether the allowance for doubtful accounts is reasonable. Cutoff testing also matters because sales near year-end can be misstated. Be sure to mention existence, valuation, confirmations, subsequent cash receipts, aging analysis, allowance for doubtful accounts, cutoff testing, and professional skepticism around collectability. Question 9. What is audit evidence, and what makes it persuasive? Audit evidence is the information used to support the auditor's conclusions. Sufficiency is about quantity. Appropriateness is about quality. Evidence is usually more reliable when it comes from independent external sources, is obtained directly by the auditor, or exists in original form. For example, a bank confirmation is stronger than an internal cash schedule. Audit evidence is persuasive rather than absolute, because audits use sampling, judgment, and reasonable assurance. While answering, cover sufficiency versus appropriateness, relevance and reliability, external evidence, original documents, direct auditor evidence, and why auditors seek persuasive rather than absolute proof. Question 10. How would you respond if a client is slow to provide requested documents? I would first make sure my request is clear, specific, and prioritized, because vague requests slow clients down. I would follow up professionally, explain why the item is needed, and agree on a realistic timing. If the delay affects critical testing or the audit timeline, I would update my senior early rather than waiting. I would also look for alternative evidence where appropriate. The key is to protect audit quality while maintaining a respectful client relationship. In your answer, show professionalism, organization, escalation judgment, communication, prioritization, and awareness that delayed evidence can affect deadlines, testing completion, and audit quality. Question 11. What does professional skepticism mean to you? Professional skepticism means having a questioning mindset and not accepting information at face value just because it comes from management. It does not mean assuming the client is dishonest. It means verifying explanations with evidence. If a margin trend changes sharply, I would ask why and then corroborate that explanation with data. Skepticism is especially important for estimates, revenue, impairment, and unusual transactions because judgment or bias can affect the financial statements. Make sure to cover questioning mind, not assuming dishonesty, corroborating management explanations, identifying inconsistent evidence, and applying skepticism, especially in estimates, revenue, related parties, and unusual transactions. Question 12. How would you test cash and bank balances? Cash testing often starts with agreeing the general ledger balance to the bank reconciliation and then to the bank confirmation. I would inspect reconciling items such as outstanding checks and deposits in transit to ensure they clear after year-end. I would also consider whether any cash is restricted and needs separate disclosure. Cash may seem simple, but because it is highly liquid, auditors still need to be alert to fraud risk and unusual movements. Be sure to mention bank confirmations, bank reconciliations, outstanding checks, deposits in transit, cutoff, restricted cash, and why cash is usually straightforward, but fraud sensitive. Question 13. What is the difference between an audit, a review, and a compilation? An audit provides reasonable assurance and involves risk assessment, control understanding, substantive testing, and an opinion on whether the financial statements are fairly presented. A review provides limited assurance, mainly through inquiries and analytical procedures, so it is less extensive. A compilation provides no assurance. The accountant helps present financial information based on management's data. The difference is important because users rely differently on each report, depending on the level of work performed. While answering, compare the level of assurance, procedures performed, independence requirements, report wording, and why public companies typically require audits, while smaller entities may use reviews or compilations. Question 14. How do auditors evaluate accounting estimates? Accounting estimates require extra attention because they depend on assumptions, not just invoices or bank statements. I would understand management's methodology, test the underlying data, and evaluate whether key assumptions are reasonable. For example, with an allowance for doubtful accounts, I would compare historical write-offs, customer aging, and current economic conditions. I would also consider management bias by comparing prior estimates with actual outcomes. Strong documentation is critical because estimates involve judgment. In your answer, discuss management judgment, assumptions, data quality, methodology, historical accuracy, sensitivity analysis, external evidence, and examples, such as allowance, impairment, fair value, or warranty reserves. Question 15. What are subsequent events, and how would you audit them? Subsequent events occur after the balance sheet date, but before the financial statements are issued. Some provide evidence about conditions that existed at year-end, so they may require adjustment. Others relate to new conditions and may only require disclosure. I would inquire with management, review board minutes, inspect interim financials, read legal correspondence, and consider major transactions after year-end. The goal is to determine whether the financial statements need adjustment or additional disclosure. Make sure to cover events after the balance sheet date, recognized versus non-recognized subsequent events, management inquiry, board minutes, legal letters, interim financials, and disclosure implications. Question 16. How would you assess whether a company is a going concern? Going concern is about whether the company can continue operating for the foreseeable future, usually at least 12 months from issuance. I would review cash flow forecasts, debt maturities, covenant compliance, losses, liquidity, and funding availability. I would challenge management's plans, such as refinancing, cost reductions, or capital raises, and look for supporting evidence. If substantial doubt exists, the audit team evaluates whether disclosures are adequate and whether the audit report needs modified language. Be sure to mention the company's ability to continue operating, cash flows, debt covenants, liquidity, forecasts, management plans, audit evidence, and disclosure or opinion implications. Question 17. How can data analytics improve audit quality? Data analytics can improve an audit by helping teams identify risks more precisely and test larger populations. Instead of only sampling journal entries, analytics may flag unusual postings, round dollar entries, weekend activity, or unexpected relationships. It also helps with trend analysis, such as revenue by customer or margin by product. That said, analytics do not replace professional judgment. They help auditors ask better questions, focus testing, and obtain more targeted evidence. While answering, connect analytics to risk identification, full population testing, anomaly detection, trend analysis, efficiency, and EY's technology-enabled audit approach without overstating that analytics replace judgment. Question 18. Tell me about a time you worked under pressure or tight deadlines. In a university project, our team had 3 days to complete a financial analysis after one member became unavailable. I listed the remaining tasks, split work based on strengths, and set internal checkpoints before the deadline. I also reviewed the final model for consistency instead of just submitting quickly. We delivered on time and received strong feedback. The experience taught me that under pressure, structure, communication, and quality control matter most. In your answer, use a concise STAR structure. Show prioritization, communication, teamwork, attention to quality, and connect the experience to audit busy season demands. Question 19. What would you do if you found an error in work papers you had already submitted? I would not ignore it or hope it goes unnoticed. I would first understand the nature of the error and whether it affects the conclusion, sample results, or related work papers. Then I would tell my senior promptly, propose the correction, and update the documentation properly. If it affected other areas, I would help trace the impact. Mistakes can happen, especially early on, but ownership and timely communication protect audit quality. Make sure to emphasize ownership, transparency, prompt correction, informing the senior, assessing impact, updating documentation, and learning from the issue rather than hiding it. Question 20. How would you handle receiving constructive feedback from an EY senior or manager? I would treat feedback as part of the learning process, especially in my first audit role. I would listen carefully, ask clarifying questions if needed, and make sure I understand the expected standard. Then I would apply the feedback in the next work paper or client interaction, not just acknowledge it. I also like keeping notes on recurring review comments so I can avoid repeating them. Being coachable is essential in assurance. Be sure to mention openness, active listening, clarifying expectations, applying feedback quickly, documenting learning points, and showing that you are coachable and team-oriented. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.